this is Linda Abraham, and I'm the president of Accepted and the moderator for today's webinar. Welcome to all of you for coming for the presentation, How to Pay for Your MBA. Matt Levin of CommonBond will be our presenter today. Probably the only topic that causes as much anxiety as how to get into B school is how to pay for it. And that's why we've invited an expert in student financing to speak here today. We're going to be discussing the costs associated with a graduate education in management, as well as different ways to fund that education. Matt is going to provide an awesome overview, as well as concrete options. Before we start, a few housekeeping items. Matt may ask a few questions during the presentation, and if he does, you can either respond to a poll that we'll post, or you can raise your hand in response. To raise your hand, you can do so by clicking on the hand icon, two icons underneath the horizontal orange arrow on your control panel. Please raise your hand when you find it. More of you can find it than that. Raise your hand when you find the icon, the hand icon, two icons underneath the orange arrow on your control panel. Okay, it's working. Most of you are finding. Waving your hand in front of the monitor won't do any good. All right, thank you very much. Okay, so all right, so now we got that out of the way. As usual, we're looking forward to answering all your questions, and we've set aside time for Q&A, so feel free to enter your questions in the question window. I'll review the questions submitted and choose those that have the broadest application. If we didn't have time to get to your specific question, we'll be providing several options for you to get your answers at the end of the webinar. Now, just a bit about our presenter and his company, CommonBond. CommonBond was founded in 2012 by Wharton MBA students. Its core mission is to make education, specifically graduate education, more accessible by lowering the cost of financing that education. There are other elements that make CommonBond distinctive, but we will learn about them later from Matt Levin. Matt is representing CommonBond here today, and he has many years of experience in consumer lending. Matt, now I'm finished. You can the floor or the screen and mic is all yours. Take it away.
Great. Thank you, Linda, and a big thank you to everyone who's joining us today. So today, everybody, I'm going to tell you everything you need to know about paying for your MBA. There are essentially 5 key things that you need to know and that you need to take away from this webinar today. And the 5 parts that 5 pieces of information you need to know. First one, understanding your true cost of attendance. We'll go through exactly what this means. You'll see this number bandied about, but really diving into it and getting a detailed understanding. Determining the right sources of funds, the money that you can use and that you should use to pay for your MBA. Choosing the right loan type. There's a variety of other products out of the market. I'm going to help you navigate exactly which ones you should be thinking about for your particular situation. Choosing the right lender, another key thing. Not all lenders, not all loans are created equal. And then meeting key deadlines. All this stuff will be moot unless you watch out for those deadlines and make sure that you take care of them. So before we dive right in, I'm going to give you a quick overview on CommonBond and tell you a little bit more about the background and why I'm here today. So CommonBond was founded, as Linda said, by Wharton MBAs who were exactly in your shoes at one point. And the reason CommonBond exists as a company is that our founders had to pay their way through school exclusively with loans. Because rates can be so high, the process so complex, they decided to start CommonBond. They figured out there just must be a better way. So we started with MBA degrees. We've expanded to other graduate degrees. And with our mission is to eventually bring a better way to operate, not just the student loans, but the financial services industry as a whole. Let's go to that first point, cost of attendance. So this is a number that is a calculation from your school. And this means a lot of things for you. So let's break it down in a couple different areas. The first one, this is the number that determines the maximum amount that you are allowed to borrow. You'll see that this number varies across schools, and this number will differ from the number that the loan maximum that your lender will provide you. You need to take this number and know that this is the ceiling against which you can borrow against. It may seem a lot, and there's a lot of things that are brought into that or are not brought into that. So the key breakdown here is that, and we'll go on to the next slide, is that a lot of schools try to compensate and think about what all the possible expenses that a student could incur during their period at their time when they're the student, but not everything is included in here. So there's a couple key things that are often not included. One, travel. So this could be treks, could be immersive trips, it could be charity trips, it could be spring break, winter break, anything that you've thought about potentially as part of the school curriculum or outside of it is sometimes not included in the cost of attendance. Supporting a family and partner. This is a huge one. If you have other ones that you're taking care of or considerations, especially if you're picking up and moving your life to a new city, this is often not considered in the cost of attendance. Some schools will actually do a calculation for you, but in terms of the amount you're allowed to borrow, it's typically not figured in. It's typically just a single person's expenditures. On-campus expenses. So little things that you couldn't even think about or haven't thought about. Potentially things like club dues. Typically every club charges a due. A lot of MBA students join many clubs. Interview attire, wardrobe, especially if you're looking at switching industries. You may not have a pristine closet full of suits. Other things that may be considered in here or not considered in here, things like moving and storage costs. This is typically not considered part of the cost of attendance, but is absolutely part of your individual cost of attendance for going to school. And there's another piece. I've got a bit of a misspelling here, but the last piece is around a cushion. And so just because there is a cost of attendance, just because you added all the number, doesn't mean that there will be any unforeseen circumstances. And we recommend that everyone put a reasonable amount of cushion into their calculation when thinking about what is their total cost of going to school. So let's actually do a little bit of a breakdown. Let's look at two schools right down the street from each other, HBS and MIT Sloan. If you look at the total business school expenses line, about the same. And you'll see that actually these numbers come from our own, the CommonBond's, our own MBA student loan calculator, and you can find this on our website at the URL below. We have actually taken in from about 20 different schools the total cost of attendance, broken it down, and build a calculator for you to put in additional expenses and really think about, given your individual situation, what it's actually going to cost you to go to school.
By the way, Matt,
if you look just side by side.
Just one quick comment. We're going to be sending out URLs for the loan calculator and other resources that Matt mentions in the course of the webinar. We'll be sending that out to all attendees, so you don't have to be trying to madly jot down that URL. The other thing that I failed to mention at the beginning, since I already did interrupt Matt, is that if you have questions, please feel free to post them in the question window. We'll be taking them at the end of the presentation. You can also post them on the Twitter using the handle pay4MBA. Great,
thanks, Linda. Really good point to note. So looking again at the different costs here. So HBS is an interesting one. They have something called a program support fee. This includes books, cases, web-based support materials, other types of course support. You'll notice that MIT actually breaks out books and supplies, computer separately. Computers are a really interesting one. Some schools require you to actually purchase a computer. Some schools it's optional. Tuck, for example, for class of 2015, and I believe that the class of 2016, but required that students actually purchase a computer directly through the program, and it had to be a specific model. So making sure that you understand the ins and outs of that is really important, especially if you're thinking about upgrading your hardware potentially ahead of time. If you look at room and board, another key one, this can be very different depending on lifestyle, depending on previous expectations and decisions about where you're going to live. Sometimes it'll be all wrapped up into one figure. Sometimes it's broken out separately: meals, personal expenses, housing, transportation, as MIT does. You'll notice too that there's two numbers consistent here that we've added actually, and this is part of our calculation: our once-in-a-lifetime trips and our cushion. This is something, the once-in-a-lifetime trips. Everyone has an incredible opportunity at most schools to take fantastic trips, and we highly recommend that everyone explore this. It just needs to be baked into your budget. And a $3,000 cushion. It can seem like a lot of money. I think it's really important for the just-in-case type of scenarios. So net, you can go to our site, check out the different cost of attendance where we've aggregated it in there. Key thing to evaluate is make sure that your estimates of what you're actually going to spend based on your lifestyle actually meet up with the school. And if you need to be able to take out loans against that cost of attendance, you know exactly how much you'll need. So let's talk a little bit about sources of funds. So we've seen one side of it, how much you're going to pay, but where does that money actually come from? Some obvious ones: personal savings. If you have the cash, it can be, there's potentially no worries about loans, or potentially taking out no interest or low interest loans from family. There's things like company sponsorship. This can be, a lot of people feel like this is maybe you're locking yourself into a couple more years of your employer. It can be a fantastic option if that's what you wanted to do already. And a lot of people have some frustration about the fact that they may take a company sponsorship but may decide that they want to change and do something else later. The key point to note, something that we've developed at CommonBond is and some other lenders do as well, is that we will actually, if you loan to you after you've gone to school retroactively to cover your company sponsorship. So, for example, if you go on a company sponsorship and you decide to switch careers and you owe that money back, you can actually retroactively take out a loan with CommonBond. So that's actually an advantage that many of our borrowers have taken, and something you should know is that you've always got that. For some lenders, you have that option in your back pocket. Another big pool, and one of the things you'll hear a lot about, are the government loans. So that's the Perkins, Stafford, and Grad Plus. Perkins is a relatively rare loan that people take out. It's need-based. It's at 5%, so it's typically cheaper than most options out there, and you should take it if you qualify. The Stafford loan. Many private lenders right now are competitive to the Stafford loan. And this Stafford loan is only available for amounts up to $20,500. You should evaluate based on the lender, based on all the other value proposition, whether or not, given the total cost in terms of APR, and we'll talk a little bit about how that's calculated later, but in terms of APR, whether or not the total value is worth it for you. If there's potentially maybe a slight increase or it's more expensive to go with a private lender, it can be worth it given all the other trade-offs. And then there's the Grad Plus loan. This is a relatively high origination fee of 4.288%. It's gone up over the years. The rates have gone up over the years, and many private lenders are cheaper at this point in time. Then there's the private loans. There's a variety of players out in the market. We'll walk through the evaluation framework. CommonBond is one of those. And then there's, of course, your scholarships and fellowships. Can be a great option for folks in reducing the overall cost of school. You should look at, and we recommend that everyone pursue all those available. Your financial aid office can be, and career services as well, can be a great option for finding more information about that. So the what can you use question, there's a finite amount there. The what should you use is a very, very personal decision. It depends on your individual situation, and there's no single one truth out there. There's 6 steps in a framework to follow for calculating what should you use. And these are, again, a very personal decision, and no one person's calculus is going to be the same as the others. First thing, safety net. Are you keeping some cash reserve for the worst case scenario? God forbid anything were to happen, but you should always have some level of savings to be able for unforeseen circumstances. So if you're going to be using a lot of your personal savings to pay for school, we recommend that you don't deplete your whole bank account. Cheap versus expensive debt. So this is comes down to the consideration of depending on potentially what kind of interest rate you're going to get from a lender, and thinking about potentially what kind of interest rate you would get in savings, and thinking about potentially what that total cost is in interest over the life of the loan. It can, a couple basis or 50 basis points or an inch or 1% can seem like a very little amount when you're actually taking out the loan, but you should always calculate what that total cost is going to be, and the difference, and it can swing quite widely. We'll go into calculation on the next slide here. Your risk appetite on rates. This is really about decisions around fixed or variable rates, we'll talk a little bit more about this, but basically a fixed rate doesn't change over the life of the loan. A variable may go up or down. So if you have the risk appetite for changing of rates, it's something to consider. The opportunity cost of money. This relates a little bit to the cost of thinking about cheap or expensive debt. But if you have savings, if you have potentially other places to invest capital or to loan capital from, you need to think about what is the opportunity cost of me using this money elsewhere. So if you're getting a high interest rate on loans, or excuse me, if you're getting a low interest rate, potentially if you have the long-term view, you could say I could actually invest this money. I'd rather take out loans because I know I'm going to get an average, say 5, 6, 7%, where potentially my interest rate on would be a little bit lower. You should always think about future plans and purchases. Do you want to buy a house in the next 10 years? Are you looking to settle down? Are you looking to travel? And thinking about what kind of cash reserves that you want to have on hand, and how that relates to your total expenditure, and also thinking about what your total debt is going to be in terms of debt to income ratios in the future for potentially taking out a house, because that's a number that will matter. Last piece, and one of the biggest reasons for many people for going to school, is thinking about your expected future income. When you look at the monthly payment, you look at the total interest, and you look at when you'd like to make certain kinds of life choices, making sure that you have a really good estimate, you've done your homework on what type of jobs you're looking to take and what the average salary is coming out is a key point for figuring out whether you should be taking out loans, whether you should be using savings, and how much you're going to need to be paying back. Let's go into a little bit of the detail here on loan types. Some of this may be old hat for you, especially if you have a background in finance, but I want to run through these quickly and make sure that we understand them all in terms of student loans. So interest rate and APR. You'll often hear these terms bandied about. The fundamental difference between what the interest rate of the loan and the APR is, and this is a standardization that the government has required from a regulatory perspective, is that APR includes things like origination fees and other fees. It's a way of essentially comparing loans on an equal footing. And high origination fees can absolutely impact the overall APR, and it's always important to make sure that you're comparing apples to apples. Fixed or variable rates, we talked a little bit about this. Again, fixed stays the same for the life of the loan. Variable can go up or down. Typically with a variable rate, there's basically an index. And that moves up and down. It could be LIBOR. It could be the 10-year Treasury rate. It depends on the lender. Depends on the loan. But you should know that it may go up or down the life of the loan, and so you have to have the risk appetite for thinking about the future of those rates and whether you're willing to pay potentially more in the future as the rates go up. Origination fees, another key thing. Most lenders have an origination fee for an in-school loan. CommonBonds is 2%. As I mentioned before, the Grad Plus loan is currently at 4.288%. Loan term, this is just the life of the loan, typically thought of in years. Most in-school loans these days are 10 or 15-year terms. Credit and eligibility. These are slightly different things. I'm thinking about if you're eligible for loan or you qualify. We typically talk about eligibility in that many lenders look at the school you go to, and if you attend a certain school or not, or within a network of schools, whether you're eligible for a loan. Credit is a huge factor in both in whether you're accepted or declined for a loan, and then what the actual interest rate that you will get. So this is, when we think about credit quality, it's a couple different things. It's typically your FICO score, your debt-to-income ratio. And that debt-to-income ratio is not set on your current income. Of course, you're going to be in school, excuse me. Yes, it looks at your current income, your previous income history. That, I think the key thing to consider is that may change certainly over time after you're leaving school. And that's what that difference is what a lot of the newer lenders like CommonBond are taking into consideration. International student considerations. This is a big one. Most private lenders don't finance international students. The ones that do are usually community banks or credit unions that have a deal directly with an MBA program. Keenan Flagler, a great example. They have a deal with the Carolina Coastal Credit Union that helps fund international students, and I encourage you to look directly at this, connect directly with your school's financial aid department for that. For co-signers, you hear a lot about this. Some lenders require them. We do not, for example. Depending on credit background, it may be required by a lender to go find a co-signer. It's often called soliciting a co-signer, is the technical term. And it's important to note that the co-signers can do two things. One, they can help you lower your interest rate, potentially, if your credit is not great. And they also, important to note, they may be on the hook in case you're unable to pay back your loans. We'll talk a little bit you'll hear these terms, IBR, PAYE, PSLF, a lot of them kind of bandied about in the same thing. These are all government programs available to holders of government loans. IBR is income-based repayment. As of July 1st this year, your payments, the way it works is that your payments are capped at 10% of discretionary income if you are, your income is at 150% of the poverty level for your household size. I believe for a single individual, it's about $17,000. So this is something to consider if you are going to public service or government service potentially after your loans. PAYE is similar to the IBR program. There used to be slight differences. Now it's 10% of income and over for a 20-year period. The public service loan forgiveness program is a program where if you've made 120 payments within the life of the loan, the balance will be forgiven after 20 years. The key thing to note here is the with IBR, excuse me, PSLF, is that you still have tax liability for the amount that's owed. So this is an unfortunate side effect of this loan forgiveness, because the IRS still sees it as income. And you'll hear the term disbursement a lot. This is just a technical term. This basically says, referring to the loan being paid out. So typically, lenders pay directly to the school, and then the school actually disperses the amount back to you. And we'll talk a little bit about on timelines what that actually looks like. So looking at the loan types, a basic trade-off decision it's pretty simple for looking at, say, a 10-year loan versus a 15-year loan. A lower-term loan allows you to save on interest payments over time, while a higher-term loan allows you to save on monthly payments. It's that simple. You need to decide what you want to optimize for. Do you want to maximize your savings over time or minimize your monthly payments? And that helps you just determine whether a 10-year or a 15-year loan is the best for you. So what I've done here is I've actually given you a numerical example based on the CommonBond loans. So our 10-year loan is 6.24%. Our 15-year loan is 6.74%. You notice there's about a $159 difference in monthly payments. So the remember that's also that's not just like over a couple of years. It's over a 10-year period or a 15-year period. So you need to add those up and then compare and think about what's the over that period is that lower payment worth it for you? Because however you do incur higher interest payments over the life of the loan. So the total payments on an $80,000 loan balance, a 10-year $91,684, or a 15-year $80,000 loan balance, $108,950.
Matt, maybe now would be a good time to run that poll that we thought to do, just to get an idea of where our audience is at in this process. What do you think?
That sounds like a great idea.
Okay, here we go. Simple poll for you folks. Please indicate if you are starting school this fall, in other words, you're already accepted or waitlisted and hoping to get accepted, if you're planning to apply in the fall, winter, spring, and matriculate in fall 2015, or if you're just exploring options now. If you could just indicate which best identifies you, we would greatly appreciate it. Okay. Let's wait for a few more seconds. And I'm going to count down, and we'll see the results, okay? So we have a, good, active group, fantastic. 85% have voted. 5, 4, 3, 2, 1. Okay, and then here are the results. 44% of you are starting school this fall, so obviously the need for financing is very immediate. 31% are planning to matriculate in fall 2015, and I guess you're planning ahead, and that's fantastic. And 25% are exploring options and really planning ahead in terms of how to finance their graduate education. So that is great. And again, you had 85% participation, so you really have a good sense of where the audience is at.
Fantastic. Great. So let's, thanks, Linda, for doing that. Let's dive right back in. And let's talk a little bit now about the decision-making process on choosing a lender, now that we've gone through the actual mechanics. The first thing to think about is the total cost of borrowing. So as you saw on the previous slide, depending on the loan term, depending on the rate, that can vary widely. You need to add this up. We have like I said, a great calculator at our site to be able to look at the total cost. and getting to this number and understand what you're going to be borrowing and how much it's going to cost you in interest over the life of the loan, most important thing. And that helps you compare between lenders. And remember, all that should be thought of in terms of the APR, and it should be in the total interest calculations that a lender will give you once you actually go get quotes from those lenders. We recommend that you don't just kind of look at the raw numbers and say, oh, this loan is cheaper, without looking at what your total cost is, making sure that you know what the rate you're going to get is, and thinking about things like opportunity costs of lending. Another key thing is around the loan features, and these can actually vary widely between lenders. First thing is what we call borrower protection. This is a the first thing is you hear this a lot: economic hardship forbearance. This is a feature that we have in our loans, the government has in our loans, and most lenders do. And basically, this says that if you are unable to make your payments due to some sort of job loss, other types of economic hardship, you are able to actually suspend your payments for a period of time up to a fixed amount. What this means is that you're still on the hook for the loan balance. You still have to pay that loan back, but you can suspend your payments and then end up making those payments later on with the, against that previous loan term. So a key thing to note is that typically with this forbearance is that the term of the loan does not extend, so your payments may actually be a bit higher later on. But this is a great kind of insurance policy that you have on your lending. The second piece is what we call employment protection, and this is not found on all lenders. This is something that we've actually built within our loans, and it's something. It's a program that we call Common Bridge. So this is something we think is pretty innovative in the market, and we basically do two things. First thing is we help our borrowers in forbearance find a job. We connect them to people inside the CommonBond network. We have career placement services where we help do everything from a resume review to connecting them to the right folks inside companies that they may be interested in. And secondly, we actually give people the opportunity to work with us in a consulting position. This does a couple things. It helps push our business forward, and it helps put supplemental income in the pockets of their borrowers where they get back on their feet. And we think this is there's no other program like this right now. And we've actually had a handful of people who've gone through this program, and it's been an amazing success. We've had people that have helped push our business forward, everything from a branding redesign to marketing strategy, and it's helped. On the other hand, we've helped them get back on their feet right away and into new jobs. And we're pretty excited about it. It's open to all our borrowers, and especially for MBA folks. It's a great option. They have multifaceted business skill sets, and as a growing company ourselves, we can always tap into those great skill sets and sets of experience. The other key thing with the loan feature you hear a lot about is the grace period. So this means you don't actually have, typically with a lender, you don't actually have to start paying back your loan right away the day after you graduate. You have about 6 months typically to start making payments on that loan. This gives you time to move to a new city, start the job, know exactly what your income is going to be, understand your budget. Another key thing is around prepayment penalties. So prior to 2008, a variety of lenders had some kind of unscrupulous practices that the government cracked down on. They were doing everything from not having, penalizing you for prepayment, to applying it to interest only, to actually saying, yes, we'll take it as a prepayment, paying down the balance, but people still owing the interest on it if it was full amount. That has all been clamped down on. By law, as of 2008, there are no prepayment penalties. A lender cannot simply charge you for prepaying down your loan. And so, if you decide that you say you have a 10-year loan and you want to pay it off in 3 years, you don't owe any additional interest. So this is a really key aspect to thinking about the kind of loan you want to take out, and essentially that you have this optionality built in. So if you're looking at a 15-year versus a 10-year, you know that you always have the option on the 15-year to actually prepay that loan. and a lot of people take advantage of this, especially if they get a good bonus, they have a good year, to actually reduce the overall cost of borrowing. So the other piece of choosing a lender is around company characteristics. Really three things we like to think about in here. First, around customer service. A lot of people think about, okay, well, how can I, this is such it can be totally such a hassle. I'm dealing with banks. That's why we exist, right, to cut through that, the big company hassle. And we're pretty proud of it independently. And there are, I think the market is changing, and people are really prioritizing this. So you should really think about in not just going through the loan application process and it's all done, but the fact that you are going to be continuing to interact with this lender for the next 10 years. If there's a problem, if there's a change, if there's dealing with school certification, any of the thing down the road, having a company that that cares about you and really is an advocate for you is a really critical thing. Second thing, reputation. Do your homework, read reviews, talk to people who have taken out loans that you're going to school with or going to go to school with. People really active on message boards, and you'll get a lot of really good information you wouldn't get otherwise. The last thing is around the network and the community. Something that we're pretty proud of. Hosting events, connecting our borrowers to each other. See if there's a lender that you want to work with that is able to connect you to other people to actually do more than you than just take a check every month. So let's talk a little bit about timelines. The most important thing, FAFSA timeline. So if you're going to be looking for a Perkins loan or you decide to take out Stafford, June 1st, excuse me, it's actually a typo, it's actually June 30th was the first FAFSA deadline. There's a secondary deadline is September 1st. The school deadline is the most important thing. All schools are different. You need to check in with your financial aid office directly. And one key thing to understand, and we get questions about this all the time, is that as long as you have a loan lined up by your tuition due date, even if it hasn't dispersed yet, you're fine. The school's not going to charge you late fees, not going to charge you interest, they're not going to penalize you. You should always double check with your school, but this is typically the way it works. Sometimes schools are slow in certification. Sometimes the payment schedules can be a little bit funny, but as long as you have a loan lined up by the due date of tuition, you're fine. So we talked a little bit about disbursement. This is simply just the payment process of how loans actually get paid to the school. The process is typically a couple phases. So the first thing, you apply for a loan, then your credits run. You ideally get conditionally approved for that loan. Then the loan goes to your school for school certification. So I mentioned this earlier. This actually says, the school actually has to say, yes, you are so-and-so is going to be a student at the school. After that, so that can take a long time. There's actually a big kind of rush now, and many financial aid offices are going through this and trying to process, but they can get a little backed up. So the school actually has to be involved here. Once they certify the loan, you will actually then log in again to accept, on your lender's website to accept the loan terms to officialize the loan. At that point, the loan's dispersed. Again, disbursement is just a fancy word for we're going to pay you. And we make sure, typically the way it works is the loan is paid directly to the school. So they take out the tuition amount, and then the rest is given directly to you. So that's a kind of from top to bottom there, the overview of the process of how to pay for your MBA and how to think about where the money goes in and where it goes out. Last thing to talk about really is just kind of mentioned earlier around thinking about who the lender is and what the mission, and thinking about, I think there's three things we're pretty proud of, and we think that you should look for in a lender. Make sure there's savings. Make sure you are getting a great deal on your money. Making sure that you have a simple, secure application process. It's not a hassle. Can be such a it's such an important thing, and you want to make sure that with all the other stresses going on in your life, that it's easy to get through. It shouldn't take you. We like to say we get through an application in about 7 minutes. And then service. We hold ourselves to the highest expectations, and we think that you should demand that of your lenders too. If you have any questions about anything, any questions about service and about our products, anything, I'm going to give you out my email address here. It's matt@commonbond.co. It'll also be in the follow-up email. And I'll happy to take any questions by email, and happy to take any questions now. So, Linda.
Okay. Okay, sounds good. We definitely have questions here. Let's see. James asks, is there an interest rate adjustment for electronic payments? I guess this would be from CommonBond.
Yes. So typically most lenders offer about 25 basis points for ACH payments, so we do that as well. Some lenders will set you up while you're applying. Some set you up afterwards. That's something definitely you should look for in a loan. And that's typically calculated to the total interest rate, and that can be a really significant savings over time.
Okay. David asks, is it possible to get loans to deal with a deposit for your program? When you get accepted, you're asked to make usually just a couple $100 deposit, and then there's another date where you have to put down a few $1,000s. Is that possible to get through a student loan?
That's a great question. Typically that is not considered part of the cost of attendance. There may be, in cases of certain types of economic hardship, the school may certify you for that, or and you need to contact the school's financial aid office directly with those questions. Often the answer has been no, but they do make exceptions. Since of course the cost of the loan amount or excuse me, the ability to borrow is set by the school. In terms of cost of attendance, that number is typically not in that, and typically deposits are actually due for most schools prior to the loan disbursement. So again, check with your individual school for special exceptions, and there may be potential to work out a deal with them directly. Okay.
There are tons of questions here about internationals or loans for international students. Is a guarantor or cosigner required? In most cases, yes, but not always, especially if the loan is a school-sponsored loan, but they tend to be expensive. Now, one of the questions is, does CommonBond lend to non-green card holders, non-permanent residents of the United States, or non-citizens of the United States?
So, great question. It's one of our biggest objectives is to offer an international program. We don't do that right now. It's something we've been looking at since inception. We know it's one of the biggest issues with the total percentage of students attending MBA programs. About 35% are international.
Yes.
It's a huge, and a lot of international students don't have great options. So we definitely hear you. We're working on something. We hope to have a program. At least a pilot program within the next year. So definitely something that we're looking at in a variety of different ways, working directly with the schools, doing it in an independent program. It is one of our #1 priorities.
Okay. And I assume that international students do not have access to the U.S. government loans, such as the Perkins, the Stanford, etc.
That's right. They're not eligible for government loans either.
Okay. All right. So to put it, and again, there are a lot of questions on this. I'm just summarizing the best thing for international students to do is to either attempt to get a loan in their home country or attempt to get a loan through the school that they're ultimately going to attend, because sometimes those schools do have no cosigner international loans or loans for international students. Would you agree with that?
Yes, I would. I think go directly to the school. So even if they don't have an official program, they may have or listed, they may have a partnership, or it's typically local credit unions that they work with, that they can either work with you individually, or they have a kind of a standard process. I think the most important thing, contact the school's financial aid office for this if you don't see the information on their website. But they're the best source, and they're really your advocates. A lot of people see them as kind of a faceless entity, but they're absolutely an advocate, and their #1 objective is to ensure that everyone is able to pay for school. Everyone who's accepted is able to pay for school, and that money would never be an issue for turning down a qualified applicant, or not letting or a qualified applicant not being able to attend school.
Okay. Alexandria has an interesting question. Does prepayment of one's student loan affect one's credit score?
That is a fantastic question, and we've actually written a recent blog post about that, and I'll send out that link afterwards. The answer is typically no, but it can depend. There is nothing in a formula that says, if you prepay your loan, we're going to punish you for that. Absolutely not. That's illegal, and secondly, it doesn't happen. However, there are factors that go into credit scores. One key thing is really around your debt-to-income ratio. Right. And if you essentially were to prepay a huge bulk of the loan or pay it off, and you the debt-to-income and then your total outstanding balances. So if you actually are not using any of your credit, there can be a situation where that has a slight lowering of your score. It's typically has no impact, and there are those rare exceptions. I really wouldn't, for the vast majority of people, it's not an issue, and that I would never recommend that's a consideration in the prepayment calculus. Wouldn't
it actually possibly improve your credit score because you had a debt that you've paid off successfully?
Yes, it can be, especially if you've got a really high debt-to-income ratio. Absolutely. So if you if you're really using, it's really on the high end, you can pay it down. It can help your score. If you potentially are not using any credit, worst case, could have a slight bump, but there's definitely no penalization.
Okay. Caroline asks, is it a good idea to use your Roth IRA or roll over a 401k to a traditional IRA and use that money to partially fund your MBA education, your tuition?
Right. So we get that question a lot. That's a very personal question. I think the biggest thing to consider is what does it actually cost you to take out that money? Typically, there's a penalty, an early withdrawal penalty. I believe in it's either 10 to 20%, depending on the product. And if you think about that, you have this money that was tax deferred, earning interest. And it should be not earning interest, but potentially earning a return if it's invested in the stock market, and it could be invested, returning say 7% is kind of the average for stocks over a long-term time horizon. Given the fact that your student loan could be less than 7%. If you were to actually just borrow that money, and you keep that money in your 401k or your Roth IRA or your other IRA, you could actually, over the long term, you actually end up spending more money by withdrawing that money out of your retirement savings. So, in some cases, depending on your ability to borrow, you've got issues around credit, and you potentially have a situation where you've already paid taxes, or there's no withdrawal penalty on that product, then yes, it could make sense. But for the vast majority of cases, given the opportunity costs, given the fact that student loan rates are typically relatively cheap, compared to, say, revolving debt like credit cards, right. We would, the typical answer for most people is going to be no, that you shouldn't use retirement savings.
Okay, that was a really good question. David asks about fixed versus variable rates. What does CommonBond recommend, and what does it offer?
So right now we offer two fixed rate products, a 10-year and a 15-year loan at 5.99% and 6.24%, 6.74%, and that's with an ACH reduction. And that's our fixed rate in-school product. We are exploring new products, and I wouldn't be surprised if you hear an announcement from us quite soon regarding new products. And that's an expansion of things like the price range as well as the rate range and the and some variable products as well. So, it's a very personal decision. Again, some people like having the certainty, knowing exactly what they're going to pay, right. And some of it really, and this is an interest rate environment that has been at historic lows. So these variable rate products are really attractive right now. People look at it and they say, wow. I can get, say, 3% versus 5%. That's it's what a steal, right? But if you have any expectation that interest rates are going to rise, and you have to really, do your own research and calculation here, then your variable rate product can end up being more expensive. It makes a lot of sense for a lot of people and people that are willing to stomach that risk. We don't make any kind of biased recommendation either way. It's a really very personal decision. You look at your appetite for risk, understand what the cap would be on the variable rate loan. So typically it's capped, so it wouldn't go up to say 50% or anything. I'm usually capped anywhere between 8 to 10%. So understand that worst case scenario, could you refinance that loan to a lower rate? Potentially not in a high interest rate environment. So you have to be concerned about that. And secondly, at that cap, and over that time period, would this variable rate potentially be more expensive than a fixed rate loan? And those are the two pieces of information.
Right. Partially known, but only partially known pieces of information. But yeah, it was a good question. Okay. Danielle asked, does having a mortgage work against you?
No, typically not, unless you are, you have very high debt to income ratio. So, lenders for an in-school product will typically, look at that as a much smaller piece of the equation. It can potentially work against you if you have a very high balance mortgage. If you're like on a large mortgage jumbo product, and the average expected income, current income and average future income is predicted to be relatively low. It's it's something to consider in your application process, but it shouldn't stop anyone from making a decision about purchasing a home. The tough answer is it depends. Typically for your average mortgage, in most parts of the country, it shouldn't have a major impact.
Great. Another good question. We got lots of good questions today. This is also from David. So I'm an American and want to study in a foreign program like Cambridge or INSEAD. Do you all loan for those? And this question obviously is directed to CommonBond and not just general stuff.
Right. So that's a great question. So the way CommonBond works currently is we only lend to students that attend one of our partner schools, our school network, and that's actually on our website, commonbond.co, under the FAQ page, and it'll actually be under students, and you'll see what those list of schools are currently. So currently we don't have any international schools on that list. We are evaluating regularly adding that school list. I talked earlier about hopefully some interesting things to announce in the near future, and absolutely considering, would love to expand that where we can. Typically, if you look at other private lenders, some may lend for foreign programs, some may not. It's relatively individualized. The thing, if you are an American citizen, you should be looking at, U.S.-based lenders versus foreign lenders. It's one piece of advice I can give you as well. Some lenders may cover that. We don't right now, but absolutely looking to expand in the future.
Okay. Chris asks, is it possible to fund once-in-a-lifetime trips, etc., with loans since they are not included in the official budget? You might have answered that, but maybe you can address it again.
Yeah. So you are able to borrow up to the cost of attendance, depending on how much you need and where that's budgeted. There's a point where you may hit let's say you take out the full cost of attendance and you realize that that's not enough for your once-in-a-lifetime trip. The best thing to do is actually go chat to your school's financial aid office and ask for an authorization. If it's a school-related trip, they'll typically make an exception, and they'll communicate that back to your lender, and your lender will then, as long as you're below that maximum, they will authorize that amount. So if you look at, say, the average cost of attendance over 2 years, the programs we looked at, it's typically below our total maximum of $220,000, and there's a cushion there. It could be another, depending on the school, it could be anywhere from $5,000 to $25,000. So you'd still be able to take that amount. So the answer is, if you've already gone up to you're beyond your maximum cost of attendance, then you need to get a special case. If you haven't taken out the maximum cost of attendance, you're allowed to withdraw that or borrow that money, regardless of what your stated purpose is. So you can always go back to your lender and take out more.
Okay, sounds good. James asks, one thing that happens frequently with student loans is the selling of loans to different institutions, sometimes 2 to 3 different loan providers, and sometimes with little or no notification. Is this something we can anticipate with CommonBond?
That's a great question.
Isn't it?
And I want to separate that into two separate pieces. So there's essentially who the agent is, the company that you're dealing with on the front end that's responsible for the customer service, responsible for any kind of essentially the management of that loan, and then there's the actual capital markets piece where the actual payments or the coupon and the loan balance itself is actually packaged and sold off and where that goes. So our core value proposition is around our service and around our high-touch model. And we absolutely are not ever going to change that. And you will, if you take out a CommonBond loan, you will always be dealing with a CommonBond person on the front end from a management basis, from where your payment goes, any type of other kind of ongoing customer service issues, things like if you need to go into forbearance, if you want to take care of prepayment, et cetera. The servicing of that loan on the back end, where that goes to capital markets, those can be sold off. It's something that we haven't planned to do. We may do in the future. It does not affect who you deal with from a customer service perspective. It absolutely does not affect kind of your day-to-day or how you manage your kind of any kind of issues, or the anything that may come up in any kind of policies that you need to take out, like forbearance, for example.
Okay, great. Thank you. We have a few more questions here, and we welcome additional ones. Charisse asks, are there any fellowships or scholarships still available for MBA students to apply for? If so, what? And I'm going to guess, Charisse, maybe you can clarify this, that you are planning to start in 2014. If you want to just chime in on that one. But let's assume for the moment that she is. Do you want to address fellowships or scholarships?
Yeah, I mean, it's not my biggest area of expertise in terms of what's individual to school. I believe there are still ones available. I do know that there's so much out there that a lot of people don't actually tap into it, especially if, you have an interesting background or there's some sort of, other type of affiliation. There's a lot out there, and some of them are rolling, some of them have a fixed deadline. I encourage you really to go directly to your school. They typically keep a list, and see what your options are there.
Okay. Yes, just again, this is also outside my area of expertise. Most of the scholarships and grants, the money that you do not have to pay back, my understanding is that much of that comes from the schools, and most of that has been given out by this time in the cycle. But it's not always so. You can also go to the schools and ask them, because they really do not want you to decide not to attend because you can't afford to attend. And the other option is, as Matt said, is that there are scholarships for specific niches that are sometimes very hard to find and fund. And if you happen to fit into that specific niche, then, for example, I was talking to one of my staff who was a former admissions director, and she said that every year they had a scholarship at her school for accountants attending her school who came from a specific county. And there were years when nobody got that scholarship because nobody met that criteria. But if they met that criteria, I think they had a full ride. So, check those options out.
Yep.
Okay, let's see. We still have additional questions. How about Canadian permanent residents and citizens? Are they eligible for CommonBond loans?
They are not currently. In addition to international expansion, being on the books or definitely a high priority, Canadian is as well. That's often seen as a separate than say many other countries, and we're looking at a variety of different options there, and definitely just like international programs, say abroad in Europe, students abroad from Europe or from South America or Africa, it's a huge high priority for us.
Okay, and just one clarification that's again been asked for by our wonderful audience, and that is a Social Security number, U.S. Social Security number does not equal permanent residency status, right? We are really talking about permanent residency status, correct?
That's right. So it must be a U.S. citizen or permanent resident.
Okay. All right. David, there's several Davids here, by the way. David asks, you mentioned you can use the loan money for almost anything if you don't use all the money for school. Can you use your loans to invest in the stock market?
I mean, theoretically you could. You know, it's something we wouldn't recommend. It's not the stated purpose of the loan. You know, we have seen some people with the financial engineering. You know, the issue is doing that, and we get, you know, things like where people do, they pay for their loan with cash, and then they come back to us and say, oh, well, we want to, you know, take out a loan for stuff I've already paid for to get cheap credit. You know, it's a risky maneuver, and you know, if you're going to be a financial engineer, then theoretically you could, but we really wouldn't recommend it.
Right. Money is fungible, but still has to be paid back. Right?
Yeah.
Okay. And then Vivek asks, and again, if any of you still, we've made quite a dent on this list of questions, but if there are others, please feel free to post. Vivek asks, okay, is it possible to see the slides? Will your slides, could you post your slides, perhaps a slide share, and then we can include a link to them in the email that we send to attendees and people and registrants in general. Are you planning to post the slides? Do you know, Matt?
Yeah, I'm happy to do that.
Okay. All right. So let's see, last call for questions. If anybody has a question. And one last question: How do loan rates affect credit? I guess the higher the loan rate, the harder it is to get the credit. That would be the simple answer.
Yeah, I mean, the rate you get, I think it's the inverse relationship, right? The rate you get is typically dependent on your credit. You know, currently with CommonBond loans, you know, we have one rate for our 10-year and one rate for our 15-year product. So if you are accepted, you get that rate. You know, that may change in the future. You know, we're a little bit unusual like that. You know, we're very huge focus on simplicity. You know, it depends on what rate you get, but what rate you have absolutely doesn't affect your credit score.
Okay, great. And several of you have asked if we're going to post the audio recording. We will post the video itself, which obviously will contain the audio. So yes, we will do that. And then here's an interesting one. Anshul asks, what is the lowest interest rate in the U.S. now for MBA funding in your company specifically and at other institutions?
I can't speak for other institutions.
Okay.
They actually change it quite a bit. You know, we watch numbers go up and down, and it's, you know, the kind of lowest theoretical we don't think is a fair number to bandy about, because we don't know what percentage of people actually get that loan, or actually get that loan at that rate.
You also don't know the origination fee necessarily.
Right, and that's so that can be typically that's set. That's pretty standardized, and so the APR would include that origination.
Okay.
Fee.
Okay.
But yeah, so but for us it's 5.99% with ACH reduction for our refinance loans, 6.24 for in-school, 6.74 for our in-school 10-year, 6.74 for our 15-year.
Wonderful. Okay, Matt, thank you so much for this highly informative webinar and for taking really all the questions that have been posed by the guests, by our audience. Everybody who's here are applicants and soon to be MBAs. I guess the majority of you are starting, not the majority, the plurality are starting in September. Congratulations and good luck to you both in school and with your application if you're in that part of the process. Thank you very much for joining us. As you leave, please take a moment to complete the short survey you're going to receive. We really do value your feedback. It helps us improve the webinars, choose content for the future, and just overall improve this program. You'll be able to review this webinar early next week online, and we will send out an email letting you know when it's available. Thank you again, and best of luck with your MBA applications and MBA studies.